Hey, good morning, everybody. Happy Thursday. It's March 27, 2024. Great to be with you today. It's going to be a real short daily bites here. I have an interview coming up in a few minutes, so I have to cut the short with you guys, but we'll try and do an extended one on Monday, March 31st, the last day of the month, last day of the quarter. So let's talk a little bit about the markets. Boy, quite a drop yesterday, wasn't it? Big volume, bigger volume than yesterday and than the prior day, actually. And we have what is called an evening star pattern. What is an evening star pattern? Look at the S&P 500 here. We have a green bar on Monday, we have a doji on Tuesday, and we have a down bar on Wednesday. This 3-day pattern is bearish. If we follow through today with a lower high and a lower low from yesterday, so if we estimate the S&P 500, where is the low from yesterday? That is 5694, just under 5700. If we follow through with a lower high, lower low, that is going to set this S&P 500 index up to not only fill the gap from Monday, but take out some of this lower level support that was put in place late last week. So careful. I'm going to say right now, careful. Be careful what you're doing right now, because this is a pattern that can play out in a very nasty way for the markets if it continues. All right. So evening star pattern here is quite bearish. We are nowhere real close to these all-time highs here, which came in February. I talked yesterday when I was on the media circuit about Fibonacci levels that I'm looking at. The 50% retracement level is a target I was looking at from yesterday at 58.26. If that doesn't come to fruition, well, then it's just a failure at that 58% at 50% retracement level. No big deal, it's just a failure there, right? It doesn't have to go there. But what's interesting that I found here on this chart, take a look. We see that the high the other day stopped literally right at the lows in January, right? Coincidence? Yeah, maybe not. But I found that interesting that the lows from January, where we bounced off of, was a level where sellers decided to get busy and start pushing stocks out yesterday. So if we follow through down here, that's not going to be good. We're going to see some more downside here into the next month, and maybe we make a higher low. I don't know, but as it is right now, volatility is still remains elevated here. We're at 1841. Doesn't seem very high since we were at 29 about a week and a half ago, right? But it's still pushing higher. We see rates pushing higher. Check this out right down over here, bottom over here. Look at gold, up more than 1% today, up near, it was up $40 at one point. It's up 35 bucks here. Silver is higher. Gold right up near $31 to $100 an ounce. Why isn't anybody talking about gold here? Right, gold has been on fire this year, up better than 15% in 2025. Silver is higher. Crude oil is moving. We know copper is at all-time highs as well too. So this is something we have to pay attention to, especially since traders aren't really watching this. All they're paying attention to is, oh, can I buy Nvidia today? Is Tesla on my buy list as well too? All these things are important, but you have to look at other things that are happening around you as well too. There are reasons why gold is strong right now. There are reasons why the 10-year yield continues to creep up. Okay, let's take a look at that 10-year yield real quick, and see what I'm talking about here. So the 10-year yield is right back into the range of the Fed funds futures, right? What is that? 425 to 450, right? And we know that range comes in at between here and here, right? Excuse my lines are not great. So we're right back in that range. We've been playing around, the 10-year has been playing around in that range where Fed funds futures is for a while. So what does that mean? It means the curve from the Fed funds futures to the 10-year yield is flat, right? We know the 2-year yield is had been moving down. It bounced right back up again. It's a little bit above 4% now. So it is below the it is below the Fed funds rate, but still, if you drew a curve from the Fed funds over to the 10-year yield, that's flat. And what is flat? Flat is bearish. Okay, we have an inverted curve. it's bearish, extra bearish in the short term, but longer term bullish. If it's upward sloping, it's bullish. When it's flat, it's bearish. So we have a flat curve right now. You look across the board of any commodities, any futures contracts. You took a look at the VIX, the S&P futures, gold futures, interest rate futures. Flat is not bullish. It's bearish. Okay, so we have a flat curve right now, and that's causing a lot of intensity in the selling of bonds right now. It's causing a lot of intensity in selling of small cap stocks, and we'll see that continue as long as rates continue to go up. And what's interesting is that the Fed is starting to wind down and stop their QT program, which means they're not selling as many bonds. It's going to be much more supply contraction in the bond market now that the Fed's stopping the selling, they're selling of bonds. But still, there's still a lot of debt that needs to get refinanced. We're seeing all this rollover happening with the Treasury, and we're seeing more and more bonds coming out on the market, and the Fed is not going to step in there and start buying bonds anytime soon. At least they shouldn't. But Fed funds futures continue to see maybe 3 rate cuts in 2025. I don't see it at all. In fact, we'll be lucky to get one. We're probably not going to get any at all, unless inflation starts showing some signs of coming down towards the 2% target, right? And that really is what it is, because we just saw a GDP number that came in from fourth quarter. Check that out for a second. 2.6% on the core PCE, 2.4% growth in fourth quarter. Why does the Fed have to do anything? They don't, right? Now I know obviously first quarter is a little bit controversial here. We see the GDP now is still saying it's a minus 1.8%, but 2 other Federal Reserve banks, St. Louis and New York Fed, say that we're growing at about 2 to 2.4% positive. So why does the Fed have to do anything? I ask you that one more time. They don't, right? They can sit there and wait for inflation to come down towards their target, see several readings in a row, and then they can start thinking about cutting interest rates. But until then, the market is on its own without the help from the Fed. So that's going to be it, everyone. I appreciate everyone spending a little bit of time with me. And again, I apologize, we're a little bit short today. I came back from New York last night from a really successful media trip. I was on Schwab Network yesterday afternoon. I did an hour with Maddie Mills, which is great, on Yahoo on the desk with her, and did a podcast. Also did some stuff for the street as well too. So I'm looking forward to spending a little bit more time with you guys on Monday morning on the 31st. We'll talk about things, anything tariff related, any news over the weekend, and anything that happens to today and tomorrow. So have a great day, have a great weekend, and trade well. Take it easy, take it slow, keep some puts on. I know the markets have pulled back up from the lows from overnight, which you saw over here real quickly. You saw we had a big, huge shoot down yesterday, and then it continued overnight. But we've rallied back a little bit from those lows last night, but still, it's a tepid market right now, and I think people are worried and scared and nervous about next week, which I don't think is going to be a big deal. But still, I'm not the market, right? I just have to respond and make adjustments to what the market is doing. And if the market decides to go down in front of next week, hey, I'm holding puts, and so should you. All right, have some cash available. We have a new month coming up next week, and I'm very excited about that. And again, have a great day and have a great weekend, and I'll see you guys all